Hello everyone. I hope everyone's having a good morning. And today we're going to be speaking about a topic that I found interesting. And this actually stems from my previous video on the introduction to monetary policy and rate cuts. And a friend of mine who is much more educated on the topic asked me an interesting question. He asked me, what other purpose do you think rate cuts serve other than actually rate cutting? And he sent me a bunch of documents and some texts that helped explain this. And I think that sharing it here within a presentation format would serve great purpose. And it's basically about a Fed's manipulation, hence the title. It's basically the way the Fed can use anticipated rate cuts to shift the public's perspective on the economy. So let's get into the video or the presentation. Fed's Manipulation by ODICT. So we're going to be going over the table of contents. So the first section is the current Fed policy and market expectations. So it's going to be including the Fed's stance on interest rates, overview of the Fed's current position on interest rates, and the Fed's reluctance to drop rates despite market pressures. I'm also going to be going over historical context and speculations, expectations for rate cuts in 2022 and 2023, market reactions to the Fed's decisions and speculations, impact of market expectations on financial instruments, how bond interest rates and liquidity have been influenced, and the effect on mortgage rates and bond yields. This presentation is going to be really short because there's not much to cover, but everything that I have mentioned here is going to be covered in a couple of sentences, so don't get overwhelmed. This is just a brief content manager. So the presentation is only 8 slides. It won't take that long. Second section, we'll be going over economic implications on market dynamics, effects of anticipated rate cuts on market behavior, the psychological impact of anticipated rate cuts and on borrowing and debt, how market expectations have led to lower mortgage rates and bond yield adjustments, the Fed's strategy and economic consequences, the Fed's potential avoidance of actual rate cuts due to market adjustments, the impact on the US dollar's strength and the broader economy, future outlook and considerations, potential scenarios if the Fed continues its current policy, long-term implications for market stability and economic growth. And for the final section, we're going to be going over main reasoning and overview on the speeches. So section 1, we're going to be speaking about the anticipation of rate cuts. So I'm going to be reading these and then briefly summarizing each paragraph into a couple of sentences that will be easier to understand. So there's a significant discussion about whether the Federal Reserve should lower interest rates. While many believing a rate cut is warranted, the Fed faces a dilemma. Lowering rates would negate the considerable effort taken to raise them to current levels. The Fed's commitment is to maintain high rates to address inflation, even if this causes short-term economic pain. Basically, by this chart here, you can see since 2022, we have not gotten any rate cuts. And many people are saying, okay, we're for sure going to have a rate cut sooner or later. But, lowering rates, as I mentioned in the paragraph, it would completely destroy all of the efforts that the Fed took early 2020 to get the rates this high. And when we have rates this high and we have inflation as well, this preaches for a stronger dollar. In 2022, there were widespread predictions that the Fed would cut rates multiple times in 2023. There was actually an anticipation from the public that we would cut rates 7 times within going into 2023. Midway through the year, these expectations had shifted to a more modest forecast of 3 rate cuts by the year end, So they went from 7 rate cuts to 3 rate cuts. This shift in expectations significantly impacted market behavior, with many investors anticipating these cuts. I'm not going to do a summary here because it flows into the next paragraph. Just try to focus on the last couple of words, with many investors anticipating these cuts. As the market anticipated rate cuts, bond interest rates dropped, and liquidity flowed back into the bond market. The expectation of imminent rate cuts led to changes in financial markets, influencing bond prices and yields. The market's response to the anticipated cuts have been substantial, adjusting even before any official rate changes occurred. The effect of anticipating rate cuts created the same effects that a real rate cut would do. It's self-explanatory, but I'll summarize it. Basically, as the public anticipated rate cuts, the bond interest rates, they actually dropped. And then liquidity started to flow back into the bond market, with people loaning and people anticipating that the money they're borrowing is going to get, the borrowing rate will be cheaper later, because there was a anticipation by market watchers that there is a 0.4% chance that we do not cut rates at all. So people were in the public were started thinking, there's no way that we do not cut rates, and COVID-19 plays a big role into this, and I will get into why and how in just a second. But first, I want to pay attention to this highlighted paragraph here, or sentence. Sorry, markets are upping bets the U.S. Federal Reserve will cut interest rates before its next scheduled meeting in mid-September, in what would be the first out-cycle decision since the outbreak of COVID-19 in March 2020. Basically, what it's saying here is that market watchers are basically anticipating a cut in rates in the next scheduled meeting, which is in mid-September, and it would be the first out-of-cycle decision since the outbreak of COVID-19 in March 2020. Because as you can see, since 2020, we have not had any rate cuts, and we just have been raising rates, and people are started to anticipating that, there has to be a rate cut from now. So, the impacts of anticipation. As market participants increasingly anticipate rate cuts, the effects are already visible in the financial landscape. The expectation of rate cuts has driven individuals and businesses to take on more loans and debt. As I previously mentioned, the anticipation of rate cuts is making people think that the money they're going to borrow, the interest rates on the borrow will drop soon. Operating under the assumption that borrowing costs will soon decrease. This anticipation has led to a notable drop in mortgage rates, despite no actual rate cuts being implemented. Because there's such high demand on mortgages, the rates have actually dropped, and despite no actual rate cuts being implemented. And if anyone wants to correct me on that, feel free to do so in the comments. And let's move on to the next paragraph. The bond market is also significantly influenced by these expectations. 10-year bond yields have plummeted, and bond futures have risen in response to anticipated rate cuts. So here, this is the government bond yields for the 10-year, and this is the bond futures. And notice the past few lines. The bond 10-year market has dropped, while the bond futures have actually had some rise. So with the market already adjusting to the perceived lower rates, the Fed may find itself in a position where actual rate cuts are unnecessary. The strong anticipation of cuts has led to an environment where high interest rates have not prevented borrowing or affected economic activity as might have been expected. Meanwhile, the US dollar remains robust and valuable, benefiting from the higher rates and maintaining its strength in the global economy. So what I'm basically referring to here is that they do not need to have rate cuts when the act of cutting rates, which would benefit the Fed, is already happening. The act of rate cutting, which I mentioned in my previous video, is mainly for boosting the economy, to encourage investing and spending, and that would lead to a stronger economy. But in cases like in 2020, actually I'm not going to go into that because I speak about it in the next slides. But it's important to know that the Fed is in a really good position, where the US dollar remains robust and valuable, benefiting from the higher rates and maintaining its strength in the global economy by having the same effect that rate cuts would have without having actually to rate cut. So I have a small section of a 2020 speech here. I'm going to read the health part and also read my annotation. So, with interest rates generally running closer to the effective lower bound even in good times, the Fed has less scope to support the economy during an economic downturn by simply cutting the federal funds rate. So, what they're basically acknowledging is that the limitation ability to lower rates further due to their proximity to the effective lower bound. So what this means in simpler terms is rates are already low, lowering it further induces different for future rate cuts, difficulty for future rate cuts, in case of recession. So the rates are already low. Lowering them further would induce difficulty for future rate cuts if there is an economic shock or if there is a case where they have to cut rates to boost the economy. That was for the first section. Now, section 2, we're going to add on to more of section 1. So, the reasoning behind the Fed's decisions. So, we're going to be going over the neutral rate versus the Fed funds rate first. So, the neutral rate is the interest rate at which the economy is neither growing nor shrinking. It's a theoretical rate and not directly observable, whereas the Fed fund rate is the actual rate set by the Federal Reserve. The reason behind wanting higher rates initially was to address the neutral rate. The neutral rate is where the economy is neither growing nor shrinking. It's different from the actual Fed funds rate and is a calculated number that's not publicly shared. When interest rates are near zero, it implies that the neutral rate is also close to zero. This was the situation around 2022 with both the neutral rate and the Fed funds rate near zero. The Fed couldn't raise rates effectively because there was no inflationary scenario, and low rates were intended to stimulate spending, but this wasn't happening. So this is if we also go back to the previous section, you can see the Fed funds rate during 2022 was close to nothing, close to zero, or basically at zero. Okay, and this leads us to the second last paragraph, which concludes everything in how COVID basically saved the Fed. So the COVID-19 pandemic allowed the Fed to raise interest rates, which led to inflation. Contrary to expectations, the Fed did not cut rates after COVID-19 died down because inflation continued. The expectation of rate cuts was used to manage two main outcomes. It influenced public expectations and provided an inflationary scenario to keep the dollar strong and expensive. With the neutral rates moving higher, the Fed now has more ammunition to cut rates in case of economic shock. Previously, the low neutral rate meant there was little room for rate cuts during economic downturns. The current scenario of higher rates and managed expectations helped boost the economy and prepare for future economic shocks. Before I get into the conclusion, I want to go back to the chart that I have here. And basically what I was saying is that when the neutral rates and the federal funds rate was near zero, they weren't able to cut rates because in case of an economic shock, they would have no rates to cut. But this all changed when COVID happened and there was a raise in rates. And what this allowed is for people to start anticipating rate cuts after COVID-19 died down because of its kind of control rate. When the rates reached this high at 5.5%, people started to think, okay, that was just because of COVID-19, and now we're going to be expecting a cut in the rates. And contrary to belief, that's not what happened. The rates have not changed since 2022, and we're experiencing the same interest rates. And what this does is that people start to anticipate a cut in rates after the COVID-19 died down, and this leads to a boosting economy without the Fed having to cut any rates, and they will not cut any rates because it's if cutting rates would lead to a situation where they were a couple of years ago, where it was near zero, and they would have no gunpowder to fight back if there was an economic shock. So now they're placed in a situation where the dollar is inflated and strong, and where the rates are high enough to where they can cut rates if there's an economic shock. So in conclusion, COVID-19 helped the Fed raise interest rates, leading to inflation. The expectation that the Fed would cut rates after COVID-19 is not true because inflation has persisted. This expectation is beneficial for the Fed because it achieves two goals. It influences a public perception of future rate cuts and maintains an inflationary environment that keeps the dollar strong and expensive. Additionally, the rise in neutral rates give the Fed more flexibility to cut rates if there is an economic shock. Previously, with the neutral rates near zero, the Fed had limited ability to cut rates during economic downturns. The current scenario, with higher rates and managed expectations, supports a stronger economy and prepares the Fed for potential future economic shocks. Thank you for listening to my presentation. I hope that was not too long, and I'm looking forward to making more videos like this in the future. Thank you everyone for listening.